You're going to make me blush in front of all these people, Tony, and I'm not used to being out. So thank you. It's really gracious. I, like Tony, would probably be happy to be anywhere, but I'm happy to be here with a great sense of pride to introduce you to the depth of our team, the quality of our company, and all of the opportunity that lies ahead. Tony did such a good job looking back, and I think it was Maya Angelou who said that you can't really talk about where you're going if you don't know where you've been. And so much of how we think about growth as a company is really anchored in who we are as people, as partners, and how we've really built this culture of collaboration that drives our growth forward. When we talk about Ares internally, we refer to ourselves as a growth company in a growth industry. And you'll see today, our industry is rapidly growing and we're taking disproportionate share. And one of the reasons that we're doing that is because of this growth mindset that we bring to all of our businesses, our investing activities, our capital raising activities, our impact. Everyone that works at this firm is encouraged to think about growth. How do I innovate? How do I do things differently? How do I think about a new way of attacking a market? And it's that DNA, that part of our culture that we think is so unique. It works so well because Tony said, all we talk about is collaboration. How do we break down internal silos? How do we harness the power of the platform to drive results for our investors? And hopefully you'll see today a consistency of approach across all of our activities, and you'll see that collaboration shine through. Jared's going to spend a fair amount of time talking about our financial model and the consistency of our financial returns. We are uniquely positioned in this industry because of the nature of the assets that we manage to deliver strong growth without having to sacrifice consistency or predictability of return. And I think last but not least, any time that we're making an investment at Ares, we're always thinking, how am I aligned with my management team? How am I aligned with my partners? When you look at the partnership at Ares, we own 50% of this company. We are right there shoulder to shoulder with all of you. And we have over $2 billion of capital invested in our underlying fund product, fully aligned with our private LPs as well. So over the course of today, we're going to be talking a lot about all of our businesses. And what you're going to see is we are in very large addressable markets with a significant amount of growth ahead. The business is really just firing on all cylinders. So what you'll see here is we have built a business that has a repeatable business model. It seems simple. We raise capital. We put that money to work. We generate extraordinary returns for our investors. They reward us, as Tony said, with more capital because assets follow performance, and then we do it all over again. Behind that simplicity, though, is obviously 2,000 people across the globe that are working hard every day to deliver these types of results. To put all of this in perspective, in terms of our fundraising engine that Ryan will talk about, we've been able to grow our assets under management close to 20% per year for the last 5 years. We've invested in people, office footprint, broadening our product set, and that leads to consistent and more diversified deployment across all of our businesses. And you'll see that deployment has kept pace with that fundraising, growing at 23% over the last 5 years as well. As that money gets put into the ground and we harvest it, we're driving 20% growth in our fee-related earnings and realized income. And then our investors are coming back and they're consuming more product with us and existing strategies and broadening their relationship with us. And you'll see a 20% increase in the number of institutional relationships that we have on the firm as well. And then when you put all of that together, the beauty is we're not just delivering for our private LPs, but we're delivering for our public shareholders as well. And we've delivered a 36% annualized rate of return over the last 5 years. We have been fortunate, I'm not going to lie, to be growing this business against the backdrop of a multi-decade secular growth trend in the alternative asset space. A lot of people are experiencing the accelerated growth now as a new phenomenon, but this is nothing new to us. Over the last 20 years, we've seen banks retrench from the middle market, clearing the way for the growth of a global private credit leader. We've seen the high yield and leveraged loan market restructure and move towards larger borrowers, larger issuers, paving the way for our leveraged finance and private credit businesses to grow. We're seeing the public markets grow, become more concentrated. We're seeing the length of time for companies to get to the IPO market lengthen, and companies are spending more time in the private markets. We've had a 30-year secular decline in interest rates. So the backdrop against which we've been building this business has been quite extraordinary. As we sit here today, a lot of these in-place trends are accelerating. And as you'll see throughout the course of the day, while we've enjoyed great growth historically, we think that the setup for future growth is probably better. So how has that growth translated into our response and the positioning of our company? Obviously, we've been able to grow AUM, but importantly, we've been able to diversify the number of strategies and the AUM within those strategies over time. So if you were to look at the AUM at IPO, we had about $77 billion of assets under management in 144 strategies, leveraging our historical success, as Tony mentioned, in our liquid credit and direct lending business, with growth emerging in our private equity and real estate businesses. Fast forward to today, 7 years later, that $77 billion has grown to $262 billion. We've diversified into close to 20 strategies across the globe. The number of funds that we manage is up to about 360. This allows us to go into those local markets, as Tony said, directly originating product with more impact and more relevance to those markets. The broader our product set, the more we can do for our clients. And on the other side of that, the more that we can bring into those markets, the broader the investment solutions that we can deliver to our investors. And that is that virtuous cycle as well. So with this growth mindset, how do we think about growth? How do we support growth from a business build standpoint, an infrastructure standpoint? We believe that we have a repeatable formula in place to build. Now, when we talk about investing at Ares, we often talk about pattern recognition. 20 years in the investment business, you learn a lot. You see things occurring over and over again, and you adjust your framework. We do the same as we build businesses. Business building is pattern recognition as well. We know where to look for opportunity. We know how to exploit it. We know how to build around those opportunities. We know how to scale it. So every time we're looking to grow, whether it's organic or inorganic, it starts with this very simple formula. Identify a large addressable market where there's a capital inefficiency or a need for capital that we can fill. And that need for capital can get filled where we can bring creativity or scale or flexibility, to Tony's earlier comment, to drive growth and take share. Now, the beauty is there's no shortage of large addressable markets for us to play in. And if you look at the businesses that we have today, you'll see on this slide, each of our businesses, though we're market leaders, we are operating in incredibly large total addressable markets. I believe we have one of the leading credit businesses in the market. That $10.6 trillion end market against our $168 billion of AUM. How great is it to be in a market where you can be a market leader with a 2% market share? Competition is fragmented. The competitive advantages that we're able to accumulate allow us to continue to take share, and we can take share without having to take incremental risk. And I'm not going to go through this list, but the story is the same in each of these markets. Even in certain of the markets that are maybe more mature or where we have larger market shares, like secondary solutions that Frank will talk about, are about to go through transformational growth themselves and open up more opportunity for us. In these markets, and this is key, we are operating in a backdrop of growth in alternatives. If you look over the last 5 or 6 years, the alternative asset market has been growing at roughly 8%, 1.5 times global asset growth. Alternatives are outpacing the growth in traditionals, and that trend, irrefutable, will continue. Ares has been growing 20%, 2.5 times the alternative market. And as we go through the course of the day, hopefully you'll understand why. If you look going forward between 2020 and 2025, the numbers don't change much. Traditional assets are expected to grow about 4%, alts 9%, and as we'll walk through today, we have high conviction that we'll continue our growth rate in excess of 20%. So what do we do once we establish a view on a large total addressable market? This is where we bring the power of the platform that Tony talked about. And we joke about it. I don't actually think that anybody at this firm is sick of us talking about it, because this is what we live every day. This is how we drive results and how we deliver returns to our investors and how we all share success. It does start with building competitive advantages in 3 simple ways as I think about it. 1 is through origination. 2 is through the evaluation of deals and the information edge that we can bring by harnessing everything that resides on our platform. And 3 is by building scaled portfolios and unlocking the value in those portfolios. So maybe we'll just drill down on each of those quickly to understand how they all work together and deliver outperformance. Originations is not just about growth and deployment. Originations is also about performance. When we're in these local markets, self-originating, as Tony said, and sourcing unique assets for our clients, we are allowed to be, it enables us to be incredibly selective in what we choose to do. If you were to look across all of our private markets businesses and all the thousands of deals that we look at, we typically close less than 5% of the transactions that come through the firm. That level of selectivity is ultimately what leads to the performance that you're about to see. That means that we're saying no 95% of the time. Now, we're learning when we say no, we're seeing those businesses, we're recognizing those patterns, but we're in an enviable position to say no 95% of the time and still build durable client relationships and a durable investment business. Those originations obviously then funnel into the building of large portfolios across markets, geographies, asset classes, different parts of the capital structure, liquid markets, illiquid markets. Because of our collaborative culture, because of the lack of friction between the businesses, because of the lack of siloing in our company, we're able to harness all of the information on that platform to drive better investment decisions in each of our businesses and make better portfolio management decisions as we grow. Today, we have over 3,000 companies that we touch through our investment books across Ares. And every day, we're looking into those portfolios for some information that will make us better investors. And then lastly is this idea of scale and flexibility that Tony referenced. We have learned over time that by crafting flexible pools of capital, we can attack these markets more actively, and we can be more nimble as these markets develop. We've also learned that we need to match that flexibility with scale. And as these markets are growing and consolidating, scale has become a huge advantage. You don't have to take my word for it because the proof is in the pudding. And when you look at our returns, you'll see on this slide across the credit businesses that we run, we have decades-long track records. U.S. direct lending, Ares Capital, our publicly traded BDC, has delivered a 13% total rate of return for 17 years. Tony likes to say that if you deliver somebody a 9% dividend for 17 years, you're going to make a lot of friends. I think that's true. Similar type of performance in European direct lending, alternative credit, and standout performance that we're very proud of from our partners at Ares SSG in our Asia direct lending and distressed businesses with gross IRRs of 30% and 22%. But this performance is not just isolated in our credit book. Obviously, our private equity and real estate businesses are delivering best-in-class performance. We're seeing decades-long performance in our secondary solutions business. And I want to point out, and we'll talk about this a little bit later, the early returns on our special opportunities business at 68% gross and 52% net, demonstrating the ability to scale new businesses with the same type of performance experience that we've grown accustomed to. So 3, identify large markets, deliver the power of the platform into those markets, and then what? Grow those businesses through innovation and business building. And I want to talk about how we do that. Once we get a team of talented people or capabilities onto this platform, whether they come organically or inorganically, the playbook is the same. They get integrated into the cultural fabric of the firm, actively collaborated with. We deliver the power of the platform in terms of all of that scale, all of that information, all of that flexibility. We capture that revenue synergy, and once we have that foundation established, we then pick our heads up and we say, where do we go next? How do we deliver an adjacent strategy? How do we expand the product suite? How do we extend distribution to new channels? How do we think about ways to leverage this team into new markets, new geographies? And if you look at the history of the firm, you'll see that almost in every case, we'll take a flagship fund or a core team and rapidly expand it into adjacent markets as we grow. So as I mentioned, this playbook is the same whether we're buying a company or we're building a team. The entry point is the only thing that's different, and if you look across the history of the firm, there are so many examples of how this playbook has been well executed. Our European direct lending business, that was a de novo team build that we started in 2007. So now, almost 15 years later, we have close to $50 billion business, market leader in that market. And we did it by investing in people, processes, and capital. And now, with that market leadership position, you'll start to see us broaden the product set and continue to grow that business. Similar story with our ASOF family. Hired a team of 20 people, built capability, scaled a fund, delivering excellent performance. Now we get to pick our heads up and say, where do we take that business now? Move into new geographies, et cetera, et cetera. Similar playbook when we make acquisitions. And you'll see here a lot of our historical acquisitions have blossomed into large global franchises for us. Indicus was really the seed of our now large and growing alternative credit platform. Area Property Partners, the seed for what is now a close to $40 billion global real estate business, and so on and so forth. But what's so exciting, as Tony mentioned, given some of our recent activity, is the huge amount of white space that we see to execute this playbook on the backs of the acquisitions of SSG, Aspida, Landmark, and Black Creek. And so while we continue to grow our core businesses, we feel that we've opened up a whole swath of opportunity and white space for us to deliver this playbook into these acquired businesses. So if that's our roadmap, one could say that maybe this is our subway map, and it's hard to read, so hopefully you guys can see it. But all of these tributaries and branches are really this depiction of what happens here from a growth perspective. You could see our direct lending business starting with ARCC, moving into SMAs, moving into senior loan funds, moving into Europe, moving into junior loan funds, and then growing into industry-specific verticals, and so on and so forth. When you grow this way, off of core strength, it's high conviction growth. It's lower risk, it's lower volatility, we can grow it more efficiently, and we can grow it with confidence. And while these markets are mature in some respects, we are finding ways to leverage our core capabilities into these large end markets to grow, and you'll see 35% growth in alt credit, 45% growth in direct lending, 40% growth in real estate, so on and so forth. The next 4 slides I'm not going to walk through just in the interest of time, but I would encourage folks, if you do have time, to take a look at these. We've put together case studies of some of these de novo and inorganic experiences in a little bit more detail so that you all could get a sense, maybe a little bit more tangibly, about how these businesses are growing and where that playbook is getting executed. So where does that leave us now? We have a deep stable of established strategic products across all of our businesses in credit, private equity, real estate, and secondaries. They are all growing with good performance. We have a whole suite of what I would call emerging strategies and products, things like our SSG senior loan product, our climate infrastructure fund, our secured income product coming out of our alternative credit business, our Pathfinder series, and so on and so forth. But what I'm most excited about is what we would call future growth or emerging fund products. These are the products that we're building for 2025 and beyond. These are the products that you don't see today running through our P&L or maybe running through our performance, but are being actively executed against that playbook and opening up yet more avenues for growth over the next 10 years. Ryan is going to walk through the distribution investments, but needless to say, while we're investing in the front-end origination and investment capability to support this growth and expansion, we're also investing in our distribution as well, building and opening up new channels of distribution globally in the institutional market, in the retail market, and in the insurance channel to make room and make way for the distribution of all of these new products. And again, when you look at the results of how we've been able to do this, hopefully you'll have as much confidence as we do in our ability to continue to take on this product set and deliver it into the market. So where does this take us? Where do we think this business can go? As we sit here today, $262 billion of AUM growth coming off of our largest fundraising year, consistent deployment, the product set has diversified. We have high confidence that if we do nothing but what's in front of us now, that 262 can double to $500 billion plus by 2025. And that's just going to come through the simple execution of the playbook that we just talked about. Scale our existing funds, launch adjacent and ancillary products, open up new distribution channels for those products, expand geographically, and so on and so forth. This $500 billion does not include any inorganic growth, and as hopefully we're demonstrating, we have a long track record and experience of success bringing new capabilities and new products onto the platform through acquisition. And so to the extent that we did that, obviously these numbers can grow from here. So I'm going to end this section where I started, which is I could not be more proud of the team that we've built and the performance that we've delivered. It's days like this where you're probably the most excited to be able to share the depth of the team, the depth of the capability with all of you. It's an exciting time here. We're firing on all cylinders, as I said, putting up record numbers across the board and having a lot of fun doing it. So I'm going to now call up Jared Phillips, my partner and CFO, who's going to talk a little bit about the financial metrics underpinning some of this growth opportunity and walk you through what the future looks like from a numbers perspective. So, Jared?